Motley Fool claims they have found an industry about to jump 1,200%. I reveal the stocks being pitched here so you don't have to buy their newsletter, and I analyze them to see if 1,200% gains is actually possible. Before we do anything, let's look at the Fool's recent track record to see how good they are. They recommended ASML in August 2024, and the stock has been volatile but is up overall. They recommended 3 AI stocks in September 2024, and the first was Alphabet, and it's up 50% since. The second was Amazon, and it's only up 14% since. Meta was the last of the 3, and it's up over 30%. They recommended 2 energy stocks in November 2024, and the first was Lincoln Energy, and it's up. The second was BWX Technologies, and this is up too. The Fool recommended 5 microcaps in February 2025, and the first was Serve Robotics, and it's been volatile, but it's up. The second stock was Kiniksa Pharmaceuticals, and this stock has done really well and has basically doubled since. The third stock was Iterin Location and Control, and it's been up and down, but it's down overall. Carrot Packaging was the fourth stock, and it's down overall as well. Last was Karoo, and it is up slightly. This presentation from the Fool is about stocks that have to do with stablecoins. A stablecoin is a type of cryptocurrency designed to keep its price stable, usually by being pegged to something steady like the US dollar, euro, or gold. The Motley Fool says this about the first stablecoin stock. Another company on our list serves over 5.5 million merchants and now enables USDC stablecoin payments in 34 countries. By giving the business instant stablecoin access and cutting costly fees, we believe it's positioned to capture a slice of the potential multi-trillion-dollar market. This is Coinbase, and they reach 5 million merchants in 34 countries through their integration with Shopify payments on the Base network, enabling low-fee USDC acceptance. Here's what to know about this stock. From a simple cryptocurrency brokerage to a comprehensive financial infrastructure powerhouse, Coinbase has fundamentally transformed its business model. By late 2025, the company has successfully positioned itself as the everything exchange, seamlessly integrating spot trading, derivatives markets, and on-chain payment solutions into a unified ecosystem that serves both retail and institutional clients across the evolving digital asset landscape. Coinbase's growth is driven by a set of strong, diversified business pillars. Its core transaction revenue remains resilient, and the mix has expanded meaningfully thanks to the Deribit acquisition and the launch of U.S. perpetual futures, which pushed derivatives to capture a significant share of trading volume alongside traditional retail spot activity. Subscription and services revenue has become a major stabilizer, fueled by USDC interest income, blockchain staking rewards on networks like Ethereum and Solana, and custodial fees earned from acting as the primary custodian for major Bitcoin and Ethereum ETFs. Meanwhile, Coinbase's proprietary Ethereum Layer 2 has emerged as the breakout success of 2025, generating sequencing fees and onboarding millions of users into the on-chain economy, effectively creating an entirely new infrastructure-based revenue stream. These pillars helped drive Q3 2025 net income to roughly $433 million, reflecting continued institutional and retail engagement despite macro headwinds. With the stock pulling back around 20% during the latest crypto cooldown, investors with long-term conviction in digital asset adoption may view this moment as a compelling entry point. The bull case for Coinbase centers on a combination of regulatory clarity, institutional lock-in, and increasingly diversified revenue streams that make the company far stronger than in previous cycles. With the SEC's case dismissed in February 2025, Coinbase emerged as the only major U.S. exchange operating with full regulatory clarity, giving it the speed and confidence to launch new products while competitors remain bogged down in legal uncertainty, effectively securing a regulatory moat. At the institutional level, Coinbase has become deeply embedded as the primary custodian for giants like BlackRock, Fidelity, and other ETF issuers, creating sticky, high-switching cost relationships, reinforced by Coinbase Prime's role in their daily workflows. Revenue diversification has also transformed the business, with subscription and services now covering a large portion of fixed costs and acting as a hedge against crypto winter conditions. Even interest rate volatility works in Coinbase's favor. Lower rates typically lift crypto prices and trading activity, while higher rates drive substantial USDC yield income. Meanwhile, Base, Coinbase's Layer 2 infrastructure, positions the company to monetize on-chain usage across social, gaming, and payments, capturing value from the broader crypto economy rather than relying solely on trading. Together, these advantages form a durable and compelling long-term bull thesis. The bear case for Coinbase centers on several structural risks that could pressure profitability and valuation over time. The most significant long-term threat is fee compression. As decentralized exchanges built on Base become easier to use, traders may increasingly bypass Coinbase's main app in favor of near-zero-cost on-chain trading. While Coinbase still earns some revenue from Base activity, it cannibalizes the company's high-margin centralized trading business. Another concern is the vulnerability of interest income. When the Federal Reserve begins cutting rates in late 2025 and 2026, the lucrative USDC yield engine will shrink materially. And if trading activity doesn't rise enough to compensate, earnings may fall short of expectations. Despite its expanded business lines, Coinbase remains tightly correlated to Bitcoin, meaning a prolonged crypto winter could depress the stock regardless of strong operational execution. Finally, the company trades at a premium multiple of roughly 22 to 25 times earnings, leaving little room for disappointment. If crypto market growth slows or sentiment turns cautious, that valuation could compress sharply even if Coinbase remains profitable. Coinbase is overvalued but is currently dipping. I'd probably wait for a bit more of a dip before jumping in though. Here's the clues for the second stock. One is a company critics have said stablecoins will bypass, but it's been quietly laying the groundwork to make sure they don't. While most revenue still comes from traditional transactions, it is working with major crypto platforms to let customers spend digital dollars anywhere, while merchants get instant payments in regular currency. Our proprietary quant analysis is even projecting annualized returns as high as 25% if things continue at this pace. I'm not 100% sure about this stock, but I'm pretty sure they're pitching Visa here. They've partnered with Circle to use USDC, a major USD-backed stablecoin, to settle transactions on certain payment flows. Here's what to know about this stock. Visa operates the world's largest electronic payments network, processing trillions in annual transaction volume and serving as the technological infrastructure connecting consumers, merchants, and financial institutions without issuing cards or extending credit itself. Trading under ticker V on the NYSE, the company generated $40 billion in FY 2025 revenue, up 11% year over year, and $20.1 billion in net income, maintaining its industry-leading 50% plus margin profile. As the number one global payments network outside China, Visa's scale allows it to earn high returns by collecting fees on both payment volume and the sheer number of transactions processed, with cross-border payments remaining especially profitable thanks to their higher margins and the rebound in international travel. Shareholder returns were robust in 2025, highlighted by a 14% dividend increase and $4.9 billion in Q4 stock buybacks. Visa's bull case rests on a combination of fortress-like economics and emerging growth drivers. Operating in a durable duopoly with MasterCard, the company benefits from powerful network effects that create steep barriers to entry. Any competitor would need to simultaneously win over millions of merchants and consumers, a near impossible task that helps sustain Visa's industry-leading net margins above 50%. Despite broader macro uncertainty, Visa delivered strong FY 2025 results, with payment volume rising 8% year over year and high-margin cross-border transactions jumping 13%, all while continuing aggressive buybacks and dividend increases that appeal to income-focused investors. The company is also expanding well beyond traditional card swipes. Visa Direct is scaling rapidly for gig economy payouts and insurance disbursements, and value-added services like fraud prevention and data analytics are growing nearly 20%, proving Visa can monetize intelligence and security, not just raw volume. Together, these catalysts position Visa for sustained double-digit growth, even as mature markets plateau, with new payment flows and data-driven services offering large untapped profit pools that could further expand margins over the next decade. Visa faces a mounting set of structural threats that form a credible bear case for the stock. The U.S. Department of Justice filed a landmark antitrust lawsuit in late 2024, accusing the company of illegally monopolizing the debit card market, and a federal judge's refusal to dismiss the case in 2025 guarantees years of costly litigation with potential outcomes ranging from major fines to forced changes that could weaken Visa's pricing power and compress margins. At the same time, growing regulatory pressure, most notably from proposals like the Credit Card Competition Act, aims to break the Visa-MasterCard duopoly by requiring alternative routing options, which would allow merchants to send transactions over cheaper networks and directly threaten Visa's interchange economics. Technological disruption adds another layer of risk. Account-to-account payment systems such as FedNow in the United States and Pix in Brazil move money instantly at far lower costs, while large tech platforms and fintechs are building closed-loop payment ecosystems that could bypass traditional card rails entirely. While Visa's current fundamentals remain solid, the combination of antitrust exposure, regulatory intervention, and emerging payment technologies creates real uncertainty around the company's long-term competitive position and the durability of its premium valuation. Visa is a good stock to hold if you plan on holding it for a long period of time. This is the kind of stock you'll see in Warren Buffett's portfolio. Don't forget to grab my free report on the top 10 stocks to buy and hold forever by clicking the link in the description. And if you're looking for more Motley Fool stocks, click the video below. This is one the Fool thinks could be worth 40 Amazons.